Hello, everyone. Thanks for joining us on today's webinar with Jake Kilby, one of our very active and great chameleon traders. How you doing, D?
Good. How are you doing, Will? So I'm not seeing your screen.
Great,
I think
great. And there's Jake.
Will,
I'm here.
you might having a little bit of an internet connection issue here, but go ahead. If we don't hear you, I'll just try to kind of introduce Jake. Will you there?
All right. Well, if you can hear me, there's Jake Kilby and Dimitri on it. I am going to share my screen. Before we get started, we'll go to the disclaimer. There's the disclaimer.
Yep. So hi, everyone. And before we get started, keep in mind, Will and I, Jake, MarketChameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer questions and provide you with guidance. Will, can you bring up that disclaimer real quick so everybody could see? And in the meantime, Jake, we're going to continue kind of on is this like part 3 now?
Yeah, this is session 3 of our first call.
Yeah, exactly. And this is interesting because Jake's a member of Market Chameleon. He knows how to use the tools really well. He also, you write for Seeking Alpha. I know you write some good articles there, and you've been doing that for a while, sharing ideas. So before we get started, though, Will, would you be able to bring up that disclaimer? We'll see. I think Will's got some internet connection issues there.
Can you see it?
And here it goes. And I kind of already, like I said, guys, Will and I, Jake, Market Chameleon, we're not registered investment advisors. We're not broker dealers, and we're not telling you what to do. We're just sharing ideas today. If you need professional help, call your broker. All right. I'm not sure if we're losing Will there, but Jake, can you share your screen? Do you want to just start?
Yeah, I'll dive in. Let me start sharing my screen. Let's get it up and running. So
Okay.
Thanks guys, and thanks for the opportunity to present for the third time my little first call segment. Pretty choppy price action we've got today, which means that pretty volatile times. I think we've got the S&P down about 150 basis points, NASDAQ down as well, Dow and the Russell. So it's been pretty rough, I think, for the last 3 days in terms of price action. But then nonetheless, that's going to be an opportunity to go over a few things we've seen thus far. One of those first things we're going to look at is a bit of a recap. If you guys can remember, we did a bull put spread on NVIDIA at the time of the positioning. We put it on with NVIDIA at about $810 or thereabouts. And since then, we've kind of had it underwater. So, how did we go? Did we take it to the moon, as my little moon icon suggests, or did we crash and burn? And as you guys, particularly the guys on the Discord who trade on a day-to-day basis, are aware, I think we've got NVIDIA around about $715. So when we sold the put on the top side at 800 and bought the put at 795, well, it's gone right through our strikes. We've taken on $170 credit or thereabouts, but we've had to liquidate the position, or the position's expired or been assigned to us, and we've lost $330, which is the difference in the strike. So that one not so successful, but no big deal, because this is all about continuity and developing an edge over a large number of observations, as opposed to being a one-hit wonder. So nothing really major. Look, today I'm not really going to speak about directional risk or delta too much, but you guys are kind of familiar with it already. And, I think learning is all about just bringing things up again and again and familiarizing yourself with it. And the reason I put that down there is when you execute your trades on the Market Chameleon platform or TWS or whatever, you get a bit of an understanding of directional risk. The big, I think, reminder, so to speak, is on the call side, we have positive delta, right? And on the put side, long, of course, we have negative delta. So that's pretty important. But apart from that, I'm not really going to go into it anymore. We're going to revisit our XLE trade. So you guys may remember the select ETF, energy ETF, should I say, which we bought 2,000 units of that. We're going to have a quick look at our protective put and have a bit of an understanding of how that's working or not working. I think XLE has gone down significantly. I think we're down at 47 bucks or thereabouts right now. And most importantly, that's going to be a segue into the main theme of today's session, and that's theta. So we've kind of discovered delta, right, or directional risk, and now we're going to look at theta, or time decay, so to speak. And that's going to be really the big theme of today's trade, or today's session. I would say, and as I mentioned to Will and Dimitri a little earlier, with such choppy price action, as a trader, I generally start limiting my activity. So, and I post my trades on Discord for the guys who are interested. Today, I've taken a short position or taken a position on CL futures oil, and also on the Canadian dollar, which has gone down 1.3% against the greenback. What I think you'll see today in such volatile price action on main US indexes is a kind of flight to security. The dollar's gone up significantly. I think DXY is at about 93 or thereabouts. Real strength in the US dollar, but that's not where I'm going to go long dollar either. So just to give you guys an idea, today is going to be more about learning as opposed to getting onto, onto TWS and executing trades. We may have a look at potentially selling some calls or managing our XLE trade. But just to kind of, let me just get back here, just to kind of wrap it up, how we've gone thus far. Nothing super special. We had our covered call. Remember, in our first session, we bought the Spider Select S&P 500 ETF, and then we sold a call against it at the money. I tried to roll that. I think you guys may recall a couple of weeks back. Never got filled, so I ultimately got assigned. The stock was called away from me, so to speak, and that's what we had basically. So we had an outflow when I bought the position of about $42,000. I made a little bit selling the call, and then when it was called away from me for a little marginal profit, I made a $400 gain. Nothing super special, but again, this is more about showing you guys and developing education rather than just showing, executing trades per se. And then on the NVIDIA position, we got blown out the water. As I mentioned, we had this at, we positioned this at the 800, we had it up here, $807 when we put it on. And ultimately, I think we're down at 715. So no big deal, a $330 loss. So let's just go, before I do that, let's just flick onto the Market Chameleon just to show you guys what I'd normally do and what I'm not going to do today. But ultimately, what I endeavor to do on a bi-weekly basis is to look at this front page and put on a trade. And at the moment, there's nothing really that jumps out at me, as I mentioned to Will and Deem at the moment. Potentially a position on gold, because apart from being something which works with real yields, it's also a flight to safety. But apart from that, getting involved, Marvel is a Chinese tech firm, Allied Materials, eBay, well, these kinds of, we've got Taiwan Semiconductor, etc. I'm not really dying to get involved in any of these positions today. So let's just get straight back onto XLE and just a bit of a recap as you guys remember. And what we've got here simplistically is a very simple payoff diagram of equity, right? So this is basically a payoff of long equity. So what I mean by that is, as the stock progresses or stock price increases, so stock increase, what you find is that we have a gain. As this increases, we'll have a gain. Let's go over here. Sorry, my bad writing. And as the stock price decreases, we'll have, so decrease, we'll end up having a loss, right? So down here. And that brings me to this part here, and I kind of haven't labeled it yet because I just wanted to get you guys familiarized with it. Here are our gains, or our cash inflows. And the opposite here is our losses, right? Or cash outflows. So whenever you look at a payoff diagram on the Market Chameleon or whatever, this part here you've got to look at as gains, and the lower part you've got to look at as losses or cash outflows. Okay, so pretty important thing. So we bought 2,000 units of the XLE, and it cost us about $109,000 or thereabouts. And since then, it's gone lower. In fact, let's just have a look. Let me look on the system. So we've got the spider on the system here. Let's just have a look at XLE. Bear with me. Can you see my TWS, guys?
Yep, I can see it.
Yep.
Cool. Okay, so what you can see, I'm not going to go through this straight away, but you can see the losses sustained on the long equity position, which is offset by the positive gains on the long put session, right? So we're down at $46, $47. So I'm just going to quickly flip over. So this isn't up to date, but essentially we're down 15 grand or thereabouts. We saw it on TWS just earlier. So really house of pain, right? And this is kind of, particularly when you start off trading, you can get frustrated when a position immediately goes against you or whatever. But I guess my advice, and particularly with this position, I'm not too worried. And the reasons why is I've got a protective put, and we're going to go into that anyway, with a max loss of about $10,000 on a $1 million portfolio. So we're within that 2% max sustainable loss on any one position kind of rule that I set myself. And more importantly, I remain kind of bullish on energy. So while we're down maybe 3-4% on CL futures contracts today, we've had OPEC strike a deal. So Saudi Arabia struck a deal with the UAE. We're going to get an additional 400,000 barrels a day of oil produced. OPEC plus member Russia, the big one, not the black sheep, but the big player outside of the OPEC family, has also got a bit of a joint accord on pumping up output of crude oil. And we've got that coupled with all these fears around a new variant of coronavirus and stuff like that, which we're seeing with the price action in current equity markets. So not to fear, and it makes a good segue into that long put, right? So what we had a look at before, or what we did in the last session, is we actually purchased the December 31 $54 contract long put, and we had a cash outflow of about almost $10,000. So we bought the equity here at this position, and we start our protection, our long puts per se, starts kicking in at $54 and beyond. Now, important point here, really, just to calculate a basic break even of any long put position. So excuse my really bad writing, but it's essentially the strike minus the cost of the long put, right? And we'll see that as we long put here, and we'll see that just here. So we spent $4.80 or thereabouts. So if you go back $4.80 from 54, from about $49 or thereabouts, that long put really starts to gain momentum and starts making money. And you see that here, right? So this here is the payoff diagram for a long put. Let me just find a nice color for it. So you can see from the $54 point here, we start recovering the cash outflow. This is the cash outflow, the money which cost us to buy that long put. And as the price decreases, as the stock or the underlying decreases, that long put gains in value. It's bound by $54 and 0, okay? And that's really cool because that actually gives us a valuation floor. And that's the reason I'm not too worried. If I didn't have that, then, and the ETF, let's say XLE blew up, then I'd be exposed to the tune of $110,000. The fact that I've got a long put gives me a valuation floor to that position, that combined position, which means I'm not really too worried. And that's what we've got here. So if you look at the max loss, it's the cost of the long put, which we paid for, minus the little difference we've got here. You see this little difference we've got between the purchase price and the protection price multiplied by our units, and it gives us about $10,400 of maximum loss. The other reason I'm not too worried is I've got 6 months or thereabouts for this position to work, and I still remain bullish on oil overall. So no real changes for me. And that makes a nice little segue into the lemons to lemonade screen, right? And what I'm doing here essentially is giving you guys an overview of what happens when you put two securities together. That's what our protective put is. So we've got our long equity here, and excuse my really bad writing, but we've got that long equity in blue. And as the stock or the price increases, we make gains. As it decreases, we make losses. And then on the flip side, we've got that protective put, right, which is a net cash outflow of $9,000. But as we go past a given point, we'll start to make gains on the long put. That's really important because what does that do? That actually gives us, and I'm just going to point it out here because some of you guys may not be so familiar with payoff diagrams. That gives us, sorry, my little yellow pen, that gives us an offset. See this offset here? So as the value of the stock price or the ETF goes down, the value of the long put counterbalances that, and that gives us that neutral effect. See this neutral point here? And that gives us that natural valuation floor to the position. So what do? Well, we can just like wait it out, or we could actually start selling calls progressively on the top side just to eat away at that long put price. And let's just have a quick look on TWS. I've already had a look before we went online. Probably not going to do anything because of liquidity, but just want to give you guys a bit of an overview anyway. So we've got TWS, and you can see here, so down $15,000 on the ETF, counterbalanced by a gain of $9,000 on the long put. And you can also see the change in delta as the underlying changes. So look, let's look at options trading, XLE, 18 days out. And if you look at the 50, so look at the 54 handle to make me net neutral, you know, I'm not going to really be gaining a great deal. If I sold 10 contracts, I'm just going to give you a rough idea. It's kind of like $90. So at the moment, I'm going to park that aside and we're going to go on to the next part of the show. And if I see any difference in price action, we may reconsider it. What I wouldn't do, and this is just me personally, is I wouldn't start then selling the top side at a lower price than at which I bought the ETF. Because if all of a sudden you get a pop, then you've got to manage the loss-making call position. And that involves rolling, and it can kind of get complicated. So doing it at the purchase price, which would have been $54.50, is okay. But generally right now, you can see price action. We've got pretty wide spreads, nothing really super interesting for me. So I'll leave the call side there, but that's what we could do. And then we've got that max loss. And this is really the reason why I'm not panicking too much, because my outlook on energy in general, so crude oil in general, is pretty positive. And I've got a 1% loss on a $1 million portfolio. So nothing too much to worry about. So this leads us to the most important part of today's session, and that's what time is it? And it really is, you know, long options enemy number one, which is time decay, aka theta. And you'll see here on the Chameleon, this is a pretty important screen. Let's just see if we can. I'm just going to see if I can flip over to it for you guys in real time. Bear with me. Let me just enter the site. And we're just going to have a quick look at it. I'm going to choose anything. I'll choose the SPY. Just click on it, down click, and we'll just go over to the options chain. We're going to look at an at the money option for the SPY. Nothing special, just get anything. So buying a call expiring at the end of this week. If you hit that load strategy, here we have it, right? So this is what I want to get you guys familiarized with, is when you load up a strategy, you're familiar with delta, gamma, vega, theta, and rho, and getting an understanding of the mechanics which underlie the options you're committing to, you know, the risk that you are taking on. So, you know, it's kind of complicated with all these, you know, me, when I learned the Greeks, I found it kind of complicated with all these Greek words, you know, you've got delta and you've got theta and stuff like that. So I kind of simplified it. So for me, I try to put it in plain English. Delta being directional risk, gamma being the gearing on the delta, vega being volatility, which isn't even a Greek letter actually, theta being time or time decay, which we're going to speak about right now. And then when you think rho, think JPAL, think rates. Okay, so next time someone says, "Oh, the Delta variant," don't get too much confused with the SARS-CoV-2 pandemic. For us, it's directional risk as derivative traders. Okay, so this is it: time decay, aka theta. Now, all derivatives have an expiry, and we're not really going to delve into the world of futures and forwards and swaps. We speak specifically about options here, but these are all the larger family of derivative products, and even bonds, which aren't derivative products, but are a separate family or a separate basket of securities. Even they have a time to expiry, as opposed to residual ownership in a business, aka common stock. So on the stock side or the equity side, you have common and preferreds. I'm going to kind of park preferreds because they've got some debt-like characteristics, but common stock, buying stock in Apple or whatever, that's the terminology we use is a perpetuity. And that's because when you value stock in the old school, discounted cash flow analysis kind of thing, you assume that the company will last till perpetuity. So what is theta, or time decay? It's the daily rate of decline in the value of an option, all things else equal. And that's really important, right? Because when you guys look on your Chameleon and you say to yourself, let's go back onto the screen, here we go, we've got a delta at the money, gamma, vega, and theta, $58. So that gives you the daily decline in the value of the option, all things equal. Now, obviously, nothing's really equal, and we're in a very dynamic and fluid environment, particularly with volatility, the price action of the underlying, etc. But overall, this just gives you a yardstick for you to determine how much your option is going to lose on a day-to-day basis. And that also is dynamic. And what I mean by that is, as time progresses, or as we come closer to the expiry of that option, that time decay is going to accelerate. Now, look, why is that important? Well, that's important for a few reasons. It's mainly important for positioning and where you would want to be long options or long calls and puts, so to speak, and short options, which we haven't done yet, but also gives you an idea. So what I've got here is I've got my don't believe the hype time frame, and we've got here very simply on this side we've got the future. Okay, so the further we go out on my time chart, we've got future. The closer we go to time, we've got like today. This is Market Chameleon today, and here we've got the extrinsic value, extrinsic or time value, extrinsic value of the option. Now, important to see, what we have is further out in time, we've generally got slow decay, time decay of an option. And as we get closer and closer to the expiry date of that option, that decay picks up until we get to that kind of negative 4G dive, hair on fire, the options, the world's going to end kind of expiry date on the option. And that's important because that gives us an idea of where we want to be a buyer of options and where we want to be a seller of options. And you guys are probably saying to yourself, well, hang on. Why do I don't sell options? Why am I interested? Well, let's just take it back to our previous positions. Okay, so we had a protective put. Remember, that's what we just looked at with XLE. Sorry about my handwriting, guys, but that essentially is long equity and a long put. Well, if you want to do that protective put, you kind of want to do it out into this zone. You don't really want to be doing protective puts, on a short time frame and then rolling that position and buying and buying and buying. Because as I mentioned earlier, when you're long options, theta decay acts as a headwind. When you're short options, theta decay acts as a tailwind. Okay, and then on the short side, you think to yourself, well, hang on, Jake, I'm never selling options anyway. Well, hang on. Remember this, guys, we did a covered call. Right. And that covered call consisted of long equity and a short call. You guys remember that, right? So that short call fits in nicely in this part here. And what you would simplistically do, what I try to do with SPY, is sell that top side and then roll it. If I wanted to continue to maintain that position, I would just roll for a credit. But what I wouldn't have done, unless it was really my target or my ambition, I wouldn't have sold a call 6 months out. I wouldn't have done that. I would have taken a put, a protective put, or a long speculative call position, but I wouldn't have sold or gone short options that far out in time, just because I'm not going to benefit from the decay. Now, what I mean by that, if you're looking for protection on a basket of securities and you buy a put, and you've got a time frame for that protection, so it's like insuring a house, right? You want 6 months of insurance on your house. Well, what you're going to do is you're going to buy more time than you require and sell that position once you've used it. So if you need 6 months of protection, you would traditionally or customarily buy 9 months and then sell it once you've gotten down there, rather than waiting for it to decay. And the opposite can be said when you're short options, right? So look, that really just gives a bit of an overview of theta and theta decay, and pretty much summarizes the show for today.
Awesome job, Jake. Chameleons loved it. Thanks so much.
Awesome. Thank you, Jake. Really appreciate it. So if anybody has any questions, you could ask Jake, right? Any questions in the chat, or you could go live. If no questions, we'll just, sum it up right now and then, take another look at it when next 2 weeks or so.
Yeah,
I'll be
correct.
about right, Jake.
Correct.
I also put links in both YouTube and on Zoom to my email, williammcbride@gmail. Jake mentioned the Discord group he sent up. That's live 24 hours a day. They are discussing what's going on in the market. Different people are giving different opinions, talking about different trade ideas. It's definitely not just Chameleon focused, it's market focused, but Jake does use the Chameleon quite a bit, as do other actors on the Discord, and that's williammcbride@gmail. I will send you a link. I also put Jake's link to his Seek and Alpha articles, always worth a read. Again, Jake, thanks so much for helping put this together. The Chameleons are very appreciative. Thank you.
Thanks,
No problem.
Jake. Thanks everyone, and hope to see you guys tomorrow.
All right, Jake, we'll see you in a couple weeks. Have a great trading day, everyone. And remember, we have a morning show with D and I every morning. D goes over great pieces of the Chameleon. It's an infinite amount of information, D. Thanks for doing that every morning for us.
Thanks,
All right,
everyone.
have a great day, everyone. Bye.